Hey guys, I'm Greg Hardy, and I want to welcome you to my channel. Today we're going to dive into the world of dividend stocks. We will cover what dividend income is, and I'll show you what to look for when it comes to investing in dividend-paying stocks. We will look at the pros and cons, how to calculate the dividend yield, and by the end of this video you will be able to determine how much income you need to live on if that's something that you'd like to do. Since everyone's needs and income requirements are different, I'll show you how to calculate what you need, and you can customize your own portfolio and adjust it as needed. I've said this before, but this is what schools should be teaching you, but for some reason they don't think it's important or they just don't know how to do it. These are the types of videos that can have a real impact on your financial future, because the sooner you implement this, the more money you have the potential to make. I recently did a video on how to become a tax-free millionaire on less than $20 a day with a Roth IRA that I encourage you to watch. What we will cover in this video can be applied in a Roth IRA, so what better way to grow your wealth than by having it grow tax-free? But we will talk about the tax side of things a little bit later in this video. Honestly though, this is the stuff that can change the financial course of your life. So take a few minutes and watch this video all the way through. I think you'll find it pretty valuable. The same way I find it valuable if you hit that like and subscribe button. So let's get started. Dividends are an important aspect of investing, particularly in the stock market, where they represent a distribution of a portion of a company's earnings to its shareholders. These payments are typically made in cash, but can also be issued as additional shares of stock or other forms of property. Dividends are one of the primary ways that investors receive returns on their investment, besides the overall capital appreciation, which is the increase in the value of the stock over time. Companies pay dividends to reward their shareholders for their investment in the company. It's a way for companies to share their profits directly with those who own a stake in the business. Consistent dividend payments are attractive to investors, especially for those who are seeking passive income from their investments. Companies with a history of stable or increasing dividends can also be perceived as a financially healthy and a less risky investment. Dividend payments can be seen as a signal of a company's financial health and stability. A company that can afford to pay dividends regularly is often viewed positively by investors as a pretty good indicator of strong earnings and cash flow. Cash dividends are the most common type of dividend, where companies distribute cash to shareholders on a per-share basis. So the more shares you own, the more money you get. Shareholders can choose to either reinvest the cash dividends to purchase additional shares or receive the dividends as income. Instead of cash, companies may issue additional shares of stock to shareholders. Companies may distribute assets other than cash or stock as dividends. This could include products, services, or other forms of property. The decision to pay dividends is made by the company's board of directors. They consider various factors such as the company's financial performance, cash flow, capital requirements for growth, and shareholder expectations. Companies may have different dividend policies, ranging from not paying dividends at all to paying a steady or increasing dividend over time. The dividend yield is a measure of the dividend return on a stock, and the way you calculate the yield is by dividing the annual dividend per share price by the stock's current price per share. For example, let's take a look at Johnson & Johnson, whose current dividend is $4.76 per share, and the current share price at the time of this recording is $162.39. So we will take the current dividend price of $4.76 and divide by the share price of $162.39 and get 0.0293. We'll multiply that by 100, which is 2.94%, which is the dividend yield. The dividend yield helps investors evaluate the income they're receiving relative to the price that you're paying for the stock. So, if you want a portfolio to average 3.5% yield, then you'd look for stocks with a payout at or around that amount. As we will see later in this video, that some well-known stocks have a lower yield, while some are surprisingly high. The date on which the dividend eligibility expires is called the ex-dividend date, or simply the X date. So for example, if a stock has an X date on a Monday, then shareholders who buy the stock on or after that day will not qualify to receive the dividend for that period of time. Shareholders who own the stock one business day prior to the X date, on Friday for example, or earlier, qualify for the distribution of the dividend. There are tons of publicly traded companies that pay dividends to their shareholders. Some of these I'm sure you've heard of, like Johnson & Johnson, Procter & Gamble, Coke, AT&T, Microsoft, Apple, Verizon, and Walmart, just to name a few. Now, if you want to decrease the risk of owning individual stocks, there are some good quality ETFs that pay dividends, like SCHD from Schwab or VYM from Vanguard. SCHD is comprised of 104 stocks and pays a dividend of 3.49%. VYM is comprised of 453 stocks and has a dividend yield of 3.09%. Dividend Aristocrats and Dividend Kings are prestigious titles given to certain companies based on their history of consistently increasing dividend payments to shareholders over a long period of time. These titles are indicative of a company's financial strength, stability, and commitment to rewarding shareholders with a growing stream of income. Dividend Aristocrats are companies that are a part of the S&P 500 index and have consistently increased their dividends every year for at least 25 consecutive years. Dividend Kings are an even more exclusive group of companies that have increased their dividends every year for at least 50 consecutive years. Since everyone's desired income level is different, simply take the income amount that you want and divide by your dividend yield. So, for example, say you want $50,000 to supplement a retirement and your portfolio averages a 3.5% dividend yield. We will take the $50,000 and divide it by the yield amount of 3.5%, and that will get you the amount you need invested, which in this scenario is $1,428,571.42 to get to your hypothetical income amount. Now, before you roll your eyes and think that that number is too much and I'll never get there, wait a second and don't sell yourself short. The video I recently did about becoming a millionaire with less than $20 a day shows how possible it truly is within a tax-free Roth IRA. Say you're able to invest more than the Roth IRA allows, you can put money in a taxable brokerage account where there isn't a limit on how much you can invest. Let's break it down a little bit further. Say you want to make $500 per year on a stock. Let's see what that looks like using Apple, whose yield is 0.53%, and its stock price at the time of this recording is $175.10. You'd have to own $94,339 to make $500 per year because the yield on Apple is so low. However, Apple tends to grow pretty quickly, so dividend income is secondary over growth. Makes sense? Let's use a higher yielding stock like AT&T, whose yield is 6.56%. So to get that same $500, you'd only have to invest $7,621.95. That's a huge difference. Now, this doesn't mean that AT&T is a better stock than Apple by any means. AT&T is just more focused on paying shareholders income versus Apple, who is more centered on growing the company by reinvesting profits back into itself. Also, keep in mind that companies like those I mentioned earlier, along with many others, have a long track record of raising their dividends yearly, so consider that a pay raise that requires no additional work. Dividend investing offers several advantages that make it an attractive strategy for many investors. Dividend-paying stocks provide a steady stream of income, which can be particularly appealing for those of you seeking regular cash flow. This income can be used to supplement or even replace other sources of income. Dividend-paying stocks have historically outperformed non-dividend-paying stocks over the long term. Studies have shown that dividend-paying stocks tend to be less volatile and provide better risk-adjusted returns compared to non-dividend-paying stocks. Many dividend-paying companies have a proven track record of increasing their dividends over time. Investing in these types of companies can provide not only current income, but also the potential for future income growth as dividends increase. Dividend income has the potential to keep pace with inflation, providing investors with protection against the erosion of purchasing power over time. Companies that regularly increase their dividends may be able to outpace inflation and maintain the real value of their payouts. Companies that pay dividends must balance the desire to return cash to shareholders with the need to reinvest profits back into the business for growth. Dividend payments can provide a sense of financial security and stability for investors, especially during periods of market volatility or economic uncertainty. Knowing that you will receive regular income from your investments can help you stay the course during turbulent times. Dividend-paying stocks are found across various sectors and industries, allowing investors to build a diversified portfolio that generates income from different sources. This diversification can help reduce risk and mitigate the impact of poor performance in any single sector. Reinvesting dividends can accelerate the growth of investment portfolios over time through the power of compounding interest. By reinvesting dividends to purchase additional shares, you can benefit from the potential for exponential growth in wealth accumulation. There are some potential cons to dividend investing, like the risk of a company reducing or eliminating dividends if they experience financial difficulties, or the need to reinvest the earnings back into the business. Dividend-paying stocks are still subject to market fluctuations, so there's a risk of losing capital if the stock price declines. If dividends fail to keep pace with inflation, the purchasing power of the income generated from the dividends may decrease over time. It is worth noting that the taxes you pay on dividend income varies depending on the type of dividend and where you live. In many countries, dividends are taxed at a different rate than ordinary income. This may include qualified dividends, which are subject to lower tax rates, and non-qualified dividends, which are taxed at the investor's ordinary income tax rate. Based on 2024 taxes, you pay 0% on income up to $47,025, 15% from $47,026 to $518,900, and 20% on anything over that. So if you can keep your interest income on your account at $47,025 or less, you'll pay $0 in capital gains taxes on qualified dividend income only. So what is a qualified dividend? To qualify, you must hold that stock for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date. Confusing, I know. Just look at it this way. If you've held the stock for a few months, you're likely getting the qualified dividend rate. If you haven't, you're probably not getting it yet. Overall, dividend investing can be a rewarding strategy for those of you seeking income, stability, and long-term wealth creation. Dividends play a crucial role in investing, providing income to investors and signaling a company's financial health and stability. However, you should also consider various factors including the company's dividend policy, tax implications, and reinvestment options to make informed decisions about dividend investing. With that said, guys, thank you all so much for watching. I really hope you liked this video and you got something out of it. I encourage you to watch more videos as it relates to personal finance and investing on this channel. And if you haven't already, please like and subscribe. Thanks for watching.